Fundamental analysis in the Forex is actually one of my favorite topics, and what I hope to be able to do is to show you why they're actually a lot more fun than maybe mentally exerting, which is what I think some traders first think about when they think of fundamental analysis. And it's one of these things that does not exist in isolation from technical analysis. Fundamental analysis and technical analysis are really two sides of the same coin. And one of the reasons why fundamental analysis is so important, not only for the long-term traders, which is clear and usually pretty obvious, but even to short-term traders, is because it does such a good job of defining the trend. Now, let's talk about fundamental analysis. What exactly is fundamental analysis in the Forex? It's largely economic, and it gets to the root of the one of three things that moves exchange rates. And there are only ultimately three things that can move an exchange rate. It's just that there are a whole bunch of other things that we look at that all infer changes to those three factors. Now, the two most important of those factors are anything that would affect capital flows. So these are flows of investments, capital into and out of an economy, and things that would affect trade flows. By the way, the third thing is cross-border acquisitions of property, plant, and equipment, which is very, very small and typically does not make a difference in the Forex. Now, if you're paying attention and you took an entry-level economics course in college, you might recognize that in the U.S., what we're describing here, this is the balance of payments. So you've got your current account and your capital account over here. This is why economists are so interested in this information. It's the same reason why Forex traders are interested in this information. So what kinds of things really fall into these categories? Well, it's a variety of things. So for example, with trade flows, we get specifically trade. So we get trade numbers. Now, this is important because it's not just trade numbers, your balance or your trade deficit or your trade surplus or whatever it is, and every economy has a different situation as far as that's concerned. But it's a matter of global economy as well, because if the economy is expanding globally, so overall we're seeing economic expansion, higher employment rates, inflation, things like this, or positive inflation because of growth, then we're going to see economies that are very sensitive to trade benefit from that, because demand will be up for what they export. So whether it's raw materials, goods and services, these sorts of things. Now, over on the cash flows or on the capital flows standpoint, we have things like economic announcements like tick data, but we've got yields. We have things like interest rates. We have stock returns, bonds, demand for government debt, these sorts of things. Now, these are going to be very sensitive, obviously, during expansion. Everybody's going to be interested in high yields, high risk, which means that stock markets that are offering very high yields, economies that have very high benchmark interest rates. So if your central bank is setting a benchmark interest rate of 8%, you're probably going to attract investment and therefore demand for your currency because of capital flows. The same thing is true, but in reverse, when the global economy is really contracting, we're entering a recession, everyone becomes very risk averse, and so all of a sudden everybody wants to buy bonds. They want to store their cash in cash equivalents like government bonds. Well, I have a couple of good case studies that we can take a look at. The first one is, and I'm going to pull up a weekly chart of the Australian dollar, so the AUD, USD, and over a period of the last few years, we've had economic expansion globally, which has made the Aussie, which is very sensitive to things like commodity prices and demand for commodities, that's been very beneficial. At the same time that they've had very high benchmark interest rates. So the Australian Central Bank, the Reserve Bank of Australia, has had one of those real benchmark, real high interest rate. So both capital flow and trade flow has been definitely in favor of the Aussie. So we got this big move to the upside for several years. Now, we get to 2008. And in the middle of 2008, we really see things start to come to fruition that we saw starting to bubble up in 2007, or late 2007, and the global economy starts to enter recession, led by the U.S. And in this case, we get not only a decline in demand for commodities, which is going to hurt the Australian dollar. But we also get the Reserve Bank of Australia cutting rates like crazy to try to stimulate their own domestic economy. So all of a sudden, the two things that were in favor of the Australian dollar from a fundamental perspective just evaporated overnight. At the same time that the panics that occur as the market moves from a growth phase very quickly into a recessionary phase is very beneficial to the U.S. dollar, which is seen as a shelter to those kinds of things, because U.S. government debt is considered risk-free, or at least as close to risk-free as you can get. So that then works to the advantage of the U.S. dollar. What this means is that you have this trend that was going like this for a long time, and then all of a sudden you get a move to the downside, which is what we saw on the chart. Well, we can look at the same thing. We don't always have to be messing with the U.S. dollar to apply fundamental analysis. The same thing is also true. Let's take a look at the CAD franc, which during this recessionary environment where things were all of a sudden switching, demand for goods and services were beginning to cool off. Looking at this chart here, you can see that all of a sudden demand for the Canadian dollar, which is required to purchase those goods and basic materials, commodities, etc., demand's not as high, so we get the Canadian dollar starting to weaken. At the same time, we have this fundamental characteristic of capital flows moving into the franc for the same reasons that capital flows into the dollar during times of uncertainty. It's a shelter. There are a lot of demand for very safe investments. That's going to drive demand for the franc. Now, what direction should this push the exchange rate? It should push it to the downside in favor of the franc, as the franc gets heavier and begins to, and more fundamentally sound compared to the Canadian dollar in this exchange rate. So the takeaway here is really that we can use fundamentals to understand what's going on in the Forex and to define the trend, to define what direction should we be using our technicals to find a trade. So with the CAD franc, we should be using our technicals to time a trade to the downside. With the Aussie dollar, for years, we were looking for opportunities to the upside, and we're looking for opportunities to the downside after 2008. These situations are going to reverse again. It's inevitable. And what we're going to be looking at to try to time our, to establish our bias in the future are these same fundamentals. What can we learn about capital flows right now and the factors that will affect capital flows, and what can we learn about trade flows, and again, the factors that will affect trade flows in the future.
This video has been brought to you by Alpari.